Welcome to this Executive Knowledge lecture on Topic 8, Paper 1 of the SFC licensing exam. This topic covers accessing public capital, and we'll be looking at a number of important topics, namely listing and mergers and acquisition, but that is to follow. As ever, I will emphasize the important points to help you understand the core material you need to know to sit the exam. A copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Paper 1 Resources. And again, I strongly recommend that you supplement this learning with question practice that is provided by Examinator.online. Executive Knowledge have posted over 500 practice questions on that platform. Let's have a look at what we're going to be covering under Topic 8. We'll be, as I said, looking at the world of listings. So we'll be looking at the rules, the listing rules, and then other types of listed securities. We'll be focusing on takeovers and mergers and share buybacks and the codes, the SFC codes that go with that. Then we will consider SFC authorized products, the main two categories being collective investment schemes and structured products. And then we'll finish off by looking at alternative methods of accessing public capital, which is a relatively new section. So what are the rules governing listing? If you are listing a company in Hong Kong, you will be dealing with the stock exchange. The SFC oversees, supervises the process, but it is the stock exchange, as the second bullet point says, that administers the listing matters. And the listing rules, which are the only rules that are not subsidiary legislation. So these rules are not law. They are compiled by the stock exchange and they're intended to ensure that the applicant's listing are suitable, the fair and orderly issue and marketing of securities, provision of sufficient material and timely information for people who will want to decide whether or not they're going to invest, the fair and equal treatment of shareholders, to ensure the directors of the company act in the interests of the shareholders as a whole, particularly when there are minority shareholders, and that all new issues are first issued to existing equity shareholders by way of a rights issue. So that's what the listing rules are designed to ensure. We also have listing rules covering listings on the second market, which is the GEM, which originally stood for Growth Enterprise Market, but now we just refer to it as GEM. And it's, as it says, they are being positioned as a buyer beware market. The companies are higher risk and are looking for capital accordingly. So who are involved in the listing process? And we'll see they include the issuer itself, the company, directors of the company, authorized representatives, and we'll find out who they are in a moment, sponsors who are central to the listing process, compliance advisors who come in once a company is listed, independent financial advisors, IFAs, promoters, and reporting accountants. Now, we will look at some of these now. How much are all of these examined? Well, I can tell you the listing rules are often examined, what they are intended to ensure, and you can have at least one of the persons involved in listing addressed in the exam. So let's start with directors. Directors of an issuer, and when we say an issuer, we mean the company who wishes to list, are expected to fulfill their fiduciary duties, that's with skill, care, and diligence, and comply with a particular code, the model code for securities transactions by directors of listed companies. And that is that there are certain behaviors that directors must follow when trading shares in the company they are a director of. We're then told that every board of a listed issuer must have at least 3 independent non-executive directors, at least one of whom must have appropriate professional qualifications or accounting, financial management expertise, and at least 1/3 of the board of an issuer must be independent non-executive directors. Now, these directors must be independent, as it says, and they must submit a written confirmation to the stock exchange on their independence. And there are a number of circumstances which can compromise their independence. In other words, if that list of 6 points is breached, then their independence may be called into question, and I'll leave you to have a look through those. Controlling shareholders. Well, first of all, who are controlling shareholders? And in italics, we're told any person or group of persons who exercise or control either 30% or more of the voting shares, or who are in a position to control composition of the majority of the board of directors. So that's the definition of who a controlling shareholder is. So what? Well, the sponsor, and that's the institution, the entity that will help the issuer list and will liaise with the stock exchange. Sponsor will need to identify who are to be regarded as controlling shareholders, and they have to publicize, they have to submit details in both pre-listing and post-listing documents. Sponsor must undertake appropriate due diligence to identify who they are, and where a corporate body is a controlling shareholder, then you've got to discover who the shareholders are behind and treat them as controlling shareholders. The deal behind this is that potential investors in companies should be alerted as to who the controlling shareholders are, so that they can take a view as to whether or not there is any risk to them as potential shareholders of those that are controlling shareholders. Authorized representatives, these are the people that will act as the principal channel of communication between the issuing company and the stock exchange, and they will either be two directors of the main board or one director and the company secretary, and growth enterprise market GEM, any two from executive directors and company secretary. Now, sponsors, compliance advisors, independent financial advisors, paragraph 114. Sponsors are a major actor in this whole process. You must appoint at least one sponsor to assist with the listing application. It's the sponsor who must be approved by licensed and approved by both the SFC and the stock exchange. They will do the work liaising with the stock exchange to help the issuer become listed. If you have more than one sponsor, at least one of them must be independent of the applicant. And as I've just said, you must be licensed as a Type 6 SFC license advising in corporate finance. And then there are other conditions for being a sponsor, and we've listed them there with some sundry requirements. Be aware of what a sponsor must do. Now, compliance advisors at the bottom of page 8.4, a listed issuer must appoint a compliance advisor when it lists. And for main board listings, you must appoint that compliance advisor for 1 year, for GEM listings for 2 years. And the idea is that the compliance advisors will give advice to the listed issuer on what they have to do being a listed company. For example, when they have to publish a regulatory announcement. Independent financial advisors can give independent financial advice in a number of situations where a transaction is subject to the vote of independent shareholders or offers received with regard to a takeovers code. Now, we don't have to worry about too much detail about this. Paper 5 is where we study the detail in this area. An independent financial advisor is required to be appropriately licensed, well, it's a Type 6 license, or registered with the SFC, discharge responsibilities with due care and skill, be independent of the issuer, act impartially, and comply with the listing rules. And an IFA must satisfy itself there's a reasonable basis for making statements, and there's no reason to believe any information is not true or omits material fact. Every listed issuer should have an audit committee, minimum 3 members, majority being independent non-executive directors, and the chairman should be an independent non-exec. Different methods of listing. Now, the first four are for new listings. Offer for subscription is when new shares are created and offered to the public. An offer for sale is where existing shares that are already held by shareholders are offered for sale to the public as part of the listing. Placing is where a set number of shares are placed with usually an institution. And an introduction we don't need to have to worry about, but that is where a particular listing transaction, we introduce shares to existing shareholders. Once you're a listed company, there's a number of ways that you can list further shares. A rights issue, and a rights issue is where you issue shares to existing shareholders in proportion to the shares they hold. An open offer, same as a rights issue, except it is not in proportion to the shares that the shareholders already hold. They can apply for a set number. Capitalization issue, where we capitalize the retained earnings, the reserves, also known as a bonus issue of shares to existing shareholders, and no money is submitted. Consideration issue is where you issue shares as payment for usually an acquisition. Exchange or substitution, we don't have to worry about the detail of that. And then a transfer from GEM to main board, and that is where you're stepping up from the second market to the main board. 1.3, listing procedures and criteria. So with equity securities, straight off, you must have a trading record, that is in your business, not on the market, of at least 3 financial years under substantially the same management and ownership. An issuer must satisfy at least one of 3 quantitative tests, and there's the tests: profit test, market cap, revenue, cash flow test, market cap, revenue test. So familiarize yourself with those 3 tests, but please be aware you only have to satisfy one of the 3 to be able to list. Must be a minimum of 300 shareholders for all 3 tests. And at the time of listing, the issuer must have a minimum market cap of 500 million Hong Kong, including public float of at least 125 million. For GEM listing, track record must cover at least 2 years under substantially the same management. Now, you may be sitting there thinking, whoa, do I have to know all this detail for the exam? Well, you're going to get 1 or 2 questions on listings, and we've already covered a fair amount of the material. I'd be aware of the concepts and the general material. I wouldn't go memorizing all the numbers. I think that's just a step too far. With biotech companies, let's look at what a biotech company is. Primarily engaged in using science and technology to research, develop, apply, and commercialize products that have a medical or other biological application. And then they tell us variations on listing requirements enable pre-revenue biotech companies to gain access to public capital market during their period of development. However, must have a 2-year trading record under substantial same management. Now, as an accountant, I wince at the idea of pre-revenue companies. That is, you are a company, you're formed, but there are no revenues. Yes, you've existed for 2 years, but you wish to list on the main board. Well, yes, Stock Exchange since 2018 allow this process, and it's to attract biotech companies that are developing pharmaceutical products, biotech products, with the hope that they will be successful. And we're told the last bullet point, while the above 3 quantitative tests are not applicable, an initial market cap of 1.5 billion Hong Kong dollars is required and a public float of at least 375 million Hong Kong. And we've had a number of these in Hong Kong. Obviously, investors, a sufficient number of investors believe that they are a viable investment. Companies with weighted voting rights, top of page 8.7, and this was introduced in 2018 also. And this is to allow technology companies where the founders want to retain control, decision-making control, to allow them to list, the classic being Alibaba, which originally listed in New York, and now there's a secondary listing in Hong Kong. The point is that the founders will be granted shares where they have more voting power than an ordinary shareholder. And in the Alibaba case, it's 10 votes per one voting right compared to one vote for ordinary shareholders. And we're told there that the voting structure designed for innovation and growth companies are one of the following two tests still need to be satisfied. Market cap, time of listing must be at least 40 billion. So we're talking big. Or market cap, time of listing must 10 billion, and revenue, most recent audited financial year, of at least 1 billion Hong Kong dollars. There's a few points that we've given you there on share option schemes, not heavily examined. Share option schemes of companies that are listing, there are some slight restrictions. Price stabilization, yes, we must know about this for the exam. And this allows the issuers and underwriters to support the price of a stock for a period of time if there is a decline in the share price when listed. So the share is listed at the offer price, but the price falls below the offer price, then the issuer and the underwriter can go in and support. And the reason this is allowed is because the SFC considers it's in the public interest to allow this price stabilizing action. And there are specific price stabilizing rules, SFC rules, that provide a safe harbor for this activity. Otherwise, you'd be committing market misconduct. Now, although you don't need to know it for paper one, price stabilizing action can only last for 30 days from the date of listing, and it must be a flotation of 100 million Hong Kong dollars or more. And one point you do need to know for paper one, you are not allowed downward stabilization, only upward stabilization, and you cannot go beyond the offer price.